Inflation remains well and truly above the RBA's target band, putting it on the cusp of becoming the first G10 central bank to hike rates this cycle, and just 6 months after its easing cycle concluded. Let's start with the underlying inflation picture because that's where the RBA puts most of its emphasis. Its preferred trimmed mean inflation measure rose 0.9% in the December quarter, leaving the annual rate at 3.4%. The RBA was assuming a quarterly increase of 0.8% and year-on-year rate of 3.2%, so inflation printed above its expectations. On a 6-month annualized basis, trimmed mean is now running at 3.86%, the fastest pace since late 2023 when it was still hiking rates. With a target of 2.5%, inflation is not only elevated but accelerating further away from the bank's mandate. The RBA puts more weight on the trimmed mean measure, as its research suggests that it typically leads movements in headline inflation and not the other way around. Monthly inflation data released alongside the quarterly prints only reinforced the uncomfortably hot message. Headline inflation rose 3.8% from a year earlier in December, up from 3.4% a month earlier. Housing was yet again a key driver, with electricity prices jumping as state rebates rolled off. But more importantly, services inflation reaccelerated to 4.1% from 3.6% in November, led by domestic travel and accommodation prices. That hints that labour market tightness may be contributing to the inflation reacceleration theme. See, the RBA expected unemployment to average 4.4% in the December quarter, but instead it came in at 4.25%. That matters because the RBA was relying on a gradual loosening in labour market conditions to assist the disinflation process. That has clearly not occurred to this point. These dynamics are now reflected in market pricing. Swaps imply a 72% probability of a 25 basis point hike at the RBA's February meeting, and all 4 of Australia's major banks are also forecasting a move then. By May, after the next quarterly inflation data is received, a full hike is priced, with the probability of a second by that meeting now bordering on a coin toss. By November, more than 2 full hikes are now priced, unwinding a large proportion of the prior easing cycle, if realised. That repricing has also fed through to the Australian dollar. It has rallied sharply over recent months, supported by firmer commodity prices, elevated risk appetite, along with higher rate expectations. Of note, against Australia-US 2-year yield differentials, AUD-USD has logged correlation coefficients of 0.95 over the past week, 0.9 over the past fortnight, and 0.8 over the past quarter, suggesting it's been a major factor behind its recent outperformance, and not only against the US dollar, but also other major currencies. Reflecting that, in trade-weighted terms, the Aussie dollar is now trading at the highest level since July of 2024.